Imagine logging into your banking app and realizing your credit limit just got slashed, and you had no say in it. That's happening to Canadians right now. In this video, we're going to break down why banks are quietly lowering credit limits, what it means for your finances, and how you can protect yourself before it happens. Number 1. Banks are managing their own risk. When the economy looks shaky, like high inflation, rising unemployment, or fears of a housing downturn, banks tighten up. Cutting your limit doesn't necessarily mean you did anything wrong. It's often a blanket move. By lowering credit limits, banks reduce how much exposure they have if people default. The problem is, it feels personal because it hits your available credit instantly. Number 2, your credit report plays a bigger role than you think. Banks are constantly scanning credit files. If they see missed payments, rising balances, or even too many recent applications, they see risk. But here's the twist. Sometimes even responsible borrowers get hit. If you're not using your full credit line, a bank may see that as unused exposure and cut it. Basically, they don't want to leave open credit sitting around that isn't making them money. Number 3, lower limits can damage your credit score. Here's where it stings. When your limit drops, but your balance stays the same, your utilization ratio jumps. For example, if you owed $3,000 on a $10,000 limit, that's only 30%. But if the bank lowers you to $5,000, suddenly you're at 60%, and your credit score can take a hit, even though you didn't borrow a single extra dollar. That can make future borrowing more expensive, or even disqualify you from a mortgage. Number 4, Canadians are carrying record debt. This isn't happening in a vacuum. Canadian households have some of the highest debt levels in the world. Over $1.80 owed for every dollar of income. Banks see that number and get nervous. Combine that with higher interest rates, and suddenly, a lot of Canadians are struggling to make minimum payments. Cutting limits is one way banks protect themselves before defaults rise. Number 5, how to protect yourself. First, monitor your balances and keep your utilization under 30%. If you can, spread purchases across multiple cards to avoid one card looking maxed out. Second, don't ignore unused credit cards. Use them for a small purchase once in a while to show activity. And finally, build a safety buffer. If a bank cuts your limit, it won't throw your whole budget into chaos. So when your credit line gets cut, it's not always about you. It's about banks pulling back. The key is staying prepared so their decision doesn't wreck your finances. Stay sharp and stay informed, and subscribe if you want more real Canadian money tips.